Well, we've, of course, been watching the markets today. While it's been a slightly mixed day so far, we have seen generally weakness in recent weeks. Part of that is tied to the economic road ahead. We learned today that Canada's economy appears to have entered a technical recession. If you look at some early data that was released from Stats Canada today, which suggests a minor contraction estimated for the third quarter, does that reinforce the case for an end to interest rate hikes in this country? Let's get some more perspective on what's happening with the economy and how you should think about it as an investor as well. Phillip Colmar is a managing partner and global strategist at MRB Partners. Phillip, nice to have you back with us. To hear that Canada may have entered a technical recession at this point, does that surprise you?
No, it really doesn't. Canada's at the front edge of this rising interest rate environment, or the front edge of what gets hurt by the rising interest rate environment. We know that the household sector has excessive debt at this point. The housing market is overlevered and it's in a bubble. So the front edge of that would be that, the economy starts to weaken, consumer particularly pulls back, the economy slips into recession. What concerns me is Canada doesn't have a lot of luxury, I've mentioned this before, to fall into a mild recession. It has a quick likelihood that spirals into something much more ominous.
And what do you think then that means for something like interest rate policy in a country like Canada?
Yeah, I think the BOC is done at this point. It has to be. We've seen really it's got to keep its eye on mortgage rates. We've seen a real tightening of that, or a lift in mortgage rates associated with the 5-year. And that's really driven south of the border in the United States. But that is lifting it up. And so now the only other option is the short end. And so if homeowners, which are increasingly struggling as they get reset, they're struggling with that, and therefore their consumption patterns will pull back, the BOC's got to take note to that. I think it's done. It'll have to start to look towards a cut if economic weakness gets any more pronounced.
Phil, does that mean that getting back to so-called 2% target inflation, which obviously not just the Bank of Canada, but the U.S. Federal Reserve had been laser focused on getting price levels back to what had previously been targeted? Do we have to have a fresh conversation around that, even if we are seeing signs of inflation easing, but not quite at those target levels?
Yeah, you're getting a lot of the gifts in inflation ease off, right? The pandemic-related distortions have come out of the goods prices. Maybe there's a little bit more than that. South of the border, you get some rents because of the lagged effects. But the real core of it is the services excluding rents. And that's the heavyweight. It's heavyweight in the U.S. It's heavyweight in most countries. That takes a weakening in the labor market in order to do so, because it's the underlying trend of that is linked to wages. So first of all, I think that unless we're heading to recession, it's going to be hard to get to there. Secondly, I've been a proponent of that conversation opening, because I don't think equilibrium's 2%. We can get there. We can get anything we want, but it means suffering the economy. And if 3.5% is equilibrium, getting to 2% means a recession. That's what it means.
So let's compare it to the U.S. then. You're joining us from New York. The Fed has a decision this week. What do you think they do?
I think the Fed's on hold. I think it's done. I think we're going to see rates higher for longer. And really the discussion around monetary conditions being accommodative, restrictive, we've been in the camp that it's been accommodative. But a lot of that has been done because of a premature inversion of the yield curve. So when we think of monetary conditions, we don't just think of the Fed. We think of across the curve. A lot of borrowers borrow long dated. And so we've seen a big rise in that 10-year Treasury, up towards 5%. And the Fed needs to take a pause here and digest it. It's not that I think monetary conditions become restrictive. It's not that I think, unlike Canada, the U.S. economy is in jeopardy here. I think it's okay and it's solid. But still, we've had a big rise in that interest rate and a tightening of less accommodative monetary condition setting. So the Fed needs to digest that and watch it through.
And then I told our audience we'd put this all in context for them as investors. What does one do at a time like this, in your opinion?
Yeah, I think it's two fronts. So if you're in the fixed income space, we have been short and recommending higher bond yields. Maybe that happens again as inflation bottoms at a higher level, we'll get another wave up. But right now, people have been short on that. We're recommending that you sort of cover it. We're expecting a consolidation. Bond yields are deeply oversold. So we'd expect a digestion phase. You might want to extend duration mildly. We wouldn't be above benchmark duration here because we don't think the U.S. economy is in jeopardy. But it is a case where you should get a consolidation in that the threat of bond yields should subside. That being said, from an equity perspective, until it subsides and we get that digestion phase that's clear, I think you got to be very careful on equities here. We've been more cautious. And I think regardless, because we're talking for a higher for longer bond yield environment or cost of capital environment, I think you need to be in places where you get valuation support. and you get the potential for earnings outperformance to offset that. Unfortunately, the beloved, sort of tech sector and a lot of the growth components isn't really that. If you want to go into growth, favor more your your communication services. But other parts of the market probably look more appealing in that environment.